Most people watching this video right now will be completely wiped out of the market in the next 6 months. However, a select few who know this trick will set up the rest of their lives financially. Headlines worldwide are implying the recession coming is a sure thing, and media outlets are trying to advise how the average person can make it out alive. But how about instead I show you not only how to survive this upcoming global recession, but come out with prosper. And just before I show you this trick, how about you like and subscribe and also share this with a friend, because maybe they'll find these personal finance videos interesting. My name's Hayden, let's get into it. Now, it would make sense that if we're heading to a global recession that stocks will go down tremendously. And yes, this is true in the short term as we've seen in the last year, because the whole market is down roughly 30%. However, this is a great opportunity for the masses because stocks at heavy discounts are a great time to buy. What we know for a fact is that this is the worst start for stocks since the 70s, and this is heavily due to inflation. I mean, look at it worldwide. Russia is hinting towards economic collapse. China's over-leveraged housing market is in a bubble right now and is looking to diminish soon. And Deutsche Bank and Credit Suisse have been monitored to fall just like Bear Stearns and the Lehman Brothers did in 2008. But what you keep in mind in this video is that stocks don't go down forever. They can last a decade of just being flat or downwards returns, but over the long term, they always go up 10% roughly a year. And these short-term macroeconomic factors will have no real effect on great businesses in 15 years' time. The real reason investors can't be in the market is because they see these massive rallies like the last 2 years, and this heightened euphoria makes them not want to sell. But then on the flip side, more importantly, with these rapid declines of 30, 40, 50%, they sell instantly and then just lose their money and then be turned off from investing and don't do it again, when really if you hold long term, it's much better for you. They let these emotions affect the decisions, and just like life, if you let emotions get in the way of things, then you're likely to make a drastic mistake. Warren Buffett speaks frequently about buying cheap companies heavily discounted from their intrinsic value, then putting a margin of safety on, holding long term, and then not selling until you see some changes in the company that you may not like, and then you may decide to sell. What I do like to see though is that macroeconomic factors can affect certain areas of the market, like advertising rates currently are down tremendously. So companies like Google and Meta are so cheap right now, and that's why so many super investors are buying in heavily. According to Dataroma, out of the 79 super investors there are, 17 invested in Meta and 24 into Google just in the past second quarter alone. These super investors look so deep in every company, and that's why they're so renowned nowadays. However, don't believe them 100% because they could be wrong, they're not always right. Do your own research and you might like these companies like I do myself. The age-old saying goes, it's not about timing the market, it's about time in the market, and this is really true. Don't get caught up in large downfalls in your portfolio the same way as when they go up. Always keep a level head and stick to your investing principles, because over the long term, there's bigger gains to come, trust me. Now here's the story. When Warren Buffett bought his first stock in 1942, when he was just 11 years old, he bought it for $38.25 a share each. He had about $120 in his bank account. He told his dad to buy him 3 shares of this company that's worth $114.75 at the time. So it's totally invested. Now the stock started at $38.25 when Warren Buffett bought it. However, a couple of years later, it went all the way up to $200, and like the great man always does, he picks the right stocks. However, the stock went down to $27, and yes, he kept a level head, and then went all the way back up to $40 and he sold. So that was the first lesson Warren Buffett ever learned about investing, and that's holding on to stock if you picked a great company, because you're investing in the business, not the economic factors. So when you've picked a great business, be patient and hold long term, because the numbers will come. And he's also often stated that if you invested instead that $114.75 into the S&P 500 in 1942, at this day it'd be worth $730,000. So that's the secret. There is no secret to investing. You can look at the history of the market and say, the last time inflation was this high, it went down this much. The last time energy price was this high, it went down this much. But all we know is that it goes up 10% a year and doubles every 7 years roughly. And just stick to that. So all this outside noise doesn't matter one bit. The market always recovers as long as you're consistent with it. In fact, we should be happy the market is down. If we know it doubles every 7 years and this year it falls 30%, then that means in the next 7 years it's going to triple. It's like being dealt in poker pocket aces, the best starting hand in the game. If the first game you lose a little bit of money and you get dealt pocket aces again, that doesn't mean you just fold all of a sudden. These pocket aces represent your knowledge of the market. You can't lose over time. Anyway guys, that's a simple lesson I wanted to teach you. Heading out.